Imagine this. It's the summer of 1997. Asia is on fire in the best way. South Korea boasts skyscrapers, rising faster than anywhere on Earth. Thailand's malls are packed with new millionaires. Indonesia, Malaysia, the Philippines, they're all roaring. Wall Street calls them the Asian tigers, or miracle economies. Growth rates of 8 to 10% a year for decades. Investors can't pour money in fast enough. Everyone believes the party will never end. Then, on July 2, 1997, in a quiet announcement from Bangkok, the Thai baht collapses. What starts as a currency devaluation turns into a full-blown contagion that rips through the region like a tsunami. Stock markets crash 70 to 90%. Currencies lose half their value overnight. Iconic companies go bankrupt in days. Millions plunge from middle-class comfort into poverty. Suicides spike. Riots erupt in Jakarta. And the world watches in horror as the most celebrated economic miracle of the century implodes in months. This is the Asian financial crisis of 1997, the shocking fall of the tiger economies. Buckle up, because this story has everything. Corporate greed, political denial, shadowy hedge funds, IMF rescues, and a brutal lesson the world still hasn't fully learned. Let's set the stage. For 30 years, the Asian tigers had been the envy of the planet. Export-led growth, massive savings rates, disciplined workforces, and governments that picked winner steel, ships, semiconductors. Foreign money flooded in. First factories, then hot portfolio cash chasing high interest rates and booming stocks. By the mid-90s, Thailand, Indonesia, Malaysia, and South Korea were borrowing billions in short-term dollar loans to fund skyscrapers, luxury malls, and golf courses. Property bubbles inflated wildly. Bangkok had enough empty office space to house Manhattan twice over. But cracks were forming. These countries kept their currencies loosely pegged to the US dollar. When the dollar strengthened in 1995, their exports suddenly became expensive. Current account deficits ballooned. Thailand hit 8% of GDP. Companies and banks borrowed heavily in dollars cheap rates, but earned revenues in local currency. A classic mismatch waiting for disaster. Enter the speculators. Hedge funds like George Soros's Quantum Fund, fresh off pounding the British pound in 1992, sniffed weakness. They started shorting the Thai baht in early 1997. Thai authorities fought back, burning through $30 billion in reserves to defend the peg. Markets saw the desperation. On July 2nd, the Bank of Thailand finally surrendered, floating the baht. It plunged 20% in a day, eventually losing over 50%. Panic spread faster than anyone predicted. Investors realized every tiger had the same vulnerabilities. Pegged currencies, dollar debt, property bubbles, crony lending. One by one, the dominoes fell. Indonesia next. The rupiah lost 80% of its value by January 1998. Food prices tripled overnight. Riots exploded in Jakarta. Mobs targeted ethnic Chinese businesses in horrific violence. Over 1,000 died. President Suharto, in power for 32 years, was forced to resign in May 1998 after IMF demands clashed with his crony empire. South Korea, the crown jewel, shocked the world hardest. Giants like Hyundai and Samsung teetered. Kia Motors went bankrupt. Unemployment tripled. Proud Koreans lined up for government rice handouts. The country begged the IMF for $58 billion, the largest bailout ever at the time. Malaysia took a different path. Prime Minister Mahathir Mohamad raged against Western speculators, famously calling Soros a criminal. He defied the IMF, imposed capital controls, pegged the ringgit, and banned offshore trading. Controversial, but Malaysia recovered fastest. The human cost was staggering. Across the region, 20 to 30 million people fell back into poverty. In Indonesia, infant mortality jumped 20%. Suicide rates soared in South Korea. Families who'd finally tasted prosperity watched savings evaporate as currencies collapsed. Why did it spread so viciously? Contagion. Investors didn't distinguish. Asia was suddenly risky. Banks called in loans. Companies couldn't roll over dollar debt with devalued local money. Fire sales of assets crushed prices further. It was a vicious doom loop. The IMF rode in with rescues, but their medicine was brutal. They demanded sky-high interest rates, budget cuts, bank closures, and structural reforms. In South Korea, rates hit 40%. Thousands of firms collapsed before reforms could take hold. Critics called it IMF crisis in Korea, blaming the cure for worsening the disease. Yet, something remarkable happened. The tigers didn't just survive, they roared back stronger. By 2000, most were growing again. South Korea restructured chaebols, cleaned banks, built massive reserves. Thailand and Indonesia democratized. They learned painful lessons: floating currencies, huge forex reserves. Today, Asia holds 2/3 of global reserves, tighter regulation of short-term debt. But the biggest question lingers: did the world learn? In 2008, we saw similar bubbles, leverage in contagion only in the West. Emerging markets watched in disbelief as the US and Europe repeated many of the same mistakes. Think about it. A region that lifted hundreds of millions out of poverty in a generation almost lost everything because of borrowed dollars, fixed exchanges, and overconfidence. The Asian financial crisis wasn't just an economic event, was a warning shot about globalization's dark side. If this rollercoaster hooked you, smash that like. Drop a comment. Who was most to blame: greedy investors, reckless governments, or the IMF? And subscribe for more deep dives into the crises that shaped our world. The tigers fell hard, but they taught us how dangerous complacency can be. Stay curious, stay skeptical. See you in the next meltdown.